I need to stop you before you open that brokerage app. Because what you're about to do, or what you're planning to do, is not a financial decision. It's a psychological event. And the people on the other side of that trade understand your psychology better than you understand it yourself. They have studied it, modeled it, back-tested it, and built entire trading strategies around it. They are counting on you to do exactly what you're about to do. Let me show you what they know about you. The first thing they know is that you hate losing money more than you love making it. This is not intuition. This is one of the most replicated findings in behavioral economics. Daniel Kahneman and Amos Tversky, the researchers who won the Nobel Prize for this work, ran hundreds of experiments and consistently found that the psychological pain of losing $100 is roughly twice as powerful as the pleasure of gaining $100. Your brain responds to financial loss the same way it responds to physical pain. The insula, a brain region associated with pain, disgust, and negative emotion, lights up when you watch your investments fall. What does this mean in practice? It means you hold losing positions too long. Because selling a losing stock means accepting the loss. And accepting the loss means activating your pain system. So instead, you wait. You tell yourself it will bounce back. You check the price compulsively. Every few hours, sometimes every few minutes. Each check triggering a small anxiety response that keeps you physiologically attached to the position. You are literally in a pain avoidance loop, and the longer it runs, the more damage it does to your portfolio. Meanwhile, here's what you do with winning positions. You sell them too early. Because the moment a stock is up and you sell, the gain becomes real. The pleasure system activates, and your brain, which values certainty far above the possibility of greater gain, takes the certain pleasure of locking in the win rather than risk watching it evaporate. This pattern, hold losers, sell winners, is so universal and so well documented that it has a name. It's called the disposition effect, and it costs individual investors an estimated 1.5 to 2 percentage points of annual return. Every year, compounded over a lifetime of investing, that gap is the difference between retiring comfortably and not retiring at all. The second thing Wall Street knows about you is that you believe what you already believe. Confirmation bias is the tendency to seek out, remember, and give more weight to information that confirms your existing view. You already know this exists. What you underestimate is how completely it controls your financial decisions. When you're bullish on a stock, you read bullish articles about it. When a bearish analysis appears, you discount it. The analyst doesn't understand the company's potential. They're missing the big picture. When the stock drops, you find explanations for why this is temporary. When it rises, you feel vindicated. Notice that in none of these scenarios do you update your actual model of whether the investment is good. You are running a self-reinforcing belief loop, dressed up in the language of research. Here is what makes this particularly dangerous in the age of social media. The algorithm knows your beliefs too. The financial content you see on YouTube, on Twitter, on Reddit is filtered through systems designed to show you more of what you already agree with. You are living inside a confirmation bias machine, and you are calling the output doing your research. The third thing they know is that your brain cannot understand exponential growth. Human intuition evolved for a world where consequences were linear. If you walk twice as far, you cover twice the ground. Your brain is extraordinarily good at linear relationships. It is genuinely, structurally bad at exponential ones. Here's a test. A lily pad doubles in size every day. On day 30, it covers the entire pond. On what day did it cover half the pond? Most people guess around day 15. The answer is day 29. On day 29, the pond looks almost empty. On day 30, it's full. This is why investors consistently underestimate compounding, both in their favor and against them. They look at 10 years of index fund growth and think it's impressive. They cannot intuitively grasp that the same mechanism applied to 30 years produces a number that looks like a math error. and they look at credit card interest, 24% annually, and cannot viscerally understand that a $5,000 balance carried for 5 years without payment has become a number that feels wrong. Both are the same math. The brain simply cannot feel exponential. The people who design financial products understand this. This is why buy now, pay later products are structured in small installments. This is why mortgage interest is front-loaded. This is why the fees on actively managed funds, seemingly small at 1 or 2% annually, are buried in prospectus fine print that almost no one reads. Because 2% of assets under management, compounded over 30 years of your retirement savings, is not 2%. It is frequently the difference between having enough and running out. The fourth thing is crowd psychology, and this is the one that causes the most catastrophic individual losses. You are a social animal. Your brain monitors what other people are doing and treats group behavior as information about what is safe. This was adaptive in a world where, if everyone in your tribe started running, you should probably start running too, without stopping to find out why. In financial markets, this ancient reflex creates the conditions for bubbles and crashes. When markets are rising and everyone around you, friends, co-workers, strangers on Reddit, is making money, your brain reads the social signal. This is safe. Join the group. The FOMO response, fear of missing out, is not a personality weakness. It is a neurological event. Your brain detects social exclusion and resource loss simultaneously, activating a powerful motivational state designed to make you act. And so you buy, near the top. Just as the most sophisticated institutional players, who have been buying for months or years and are now looking for liquidity, are selling to you. This is not a conspiracy theory, it's documented market dynamics. Take retail investor inflows historically peak near market tops. The volume of Google searches for how to buy stocks spiked within weeks of both the 2000 and 2007 market peaks. When everyone is excited, the excitement itself is the warning signal. And your brain, evolved to read social excitement as a green light, cannot naturally process it as a red one. What do you do about all of this? First, automate. Every behavioral finance intervention that actually works involves removing the human decision from the loop. Automatic contributions to index funds, automatic rebalancing. These systems force you to buy consistently regardless of what the market is doing and what you're feeling about it. Second, create a written investment policy statement before you invest a single dollar. State exactly what you're investing in and why, what conditions would cause you to sell, and what you will not do under any market conditions. Write it when you are calm, follow it when you are not. The purpose is to let your rational self constrain your emotional self before the emotional event occurs. Third, consume financial media like a doctor reads pharmaceutical advertising, with the assumption that something is being sold to you. The analysis you find compelling is often the analysis that confirms your existing positions. The contrarian view you dismiss is often the one worth sitting with. The market is not a force of nature. It is a collective psychological event, driven by the same fears and hopes and cognitive errors that drive every other human behavior. The investors who outperform consistently are not smarter than you. They are simply less surprised by themselves.